So I'm joined today by David Laeha, founder of CFO Hawaii, an interim CFO who specializes in helping small business owners handle their most difficult financial challenges. David has an MBA from USC, has been a CPA since 1997, held full-time CFO positions for 12 years until starting his own firm in 2002. So David, if you're ready, I will hand it over to you.
Yes, thanks, Stacy, and welcome, and thank you all for attending. I'm David Laeha, and the company I founded in 2002 is called CFO Hawaii, an interim CFO services, professional services company. After about 30 years in accounting, as an accounting professional, I wanted to share some key points which I think will help you succeed in business. They say 9 out of 10 businesses fail, and I hope this presentation will help you be the one that succeeds. I've broken the presentation into 3 major phases of a business: the startup phase, the expansion phase, and the right-sizing phase. So whichever phase you are in, I hope you get some takeaways which could change your business and most importantly, your personal well-being for years to come. I'm covering a lot of ground and welcome your questions at the end of each of the sections of the presentation. So starting up or expanding a new business from where you're at today, the first recommendation that I have is to write a business plan. No, really, I say write a business plan. I think it's very important for you as an individual to research your industry, to understand your competition, and to build a team, not just a management team, but a good team of advisors, mentors, and others. I'll be covering these areas in more specifics later on, but I wanted to let you know that this is an area that I believe is really important for you to focus your attention at the beginning of any business plan or business venture. It lays the foundation for telling us as investors and team members that you really understand your business and the things that you're trying to endeavor. Also recommend a financial model, a very good financial model that validates your assumptions, but also conveys to investors the financial value that you bring to your business will provide. The financial model should include key drivers and assumptions you used to prepare your financial statements. It should include, at a minimum, your income statement, your balance sheet, and your statement of cash flows for over a 5-year period. And I'll be covering that in more detail as well. The second most important thing, I believe, is that you build the right management team to handle what I call functional roles. For example, marketing. You need to make sure that you have a strong marketing person. If it's not yourself, that it's a strong marketing person that can get into branding and packaging and developing marketing strategies. And some people confuse marketing and sales, but sales is a very different function. I think the most important function is the marketing aspect. The next most important, I believe, is in the finance area. To have a strong financial person who can keep track of your internal controls and your financial resources, your cash flow needs, etc. And people in the human resources function. Most people who own businesses rely entirely on the human resource aspect of their business, the people part, and having a strong human resources function is very important. Technology and legal, I kind of put toward the end there because these were the areas that you would also be really important aspects of your team. And as long, in my opinion, if you have these strong team members working with you, that you can do just about any type of business. Consultants often bring talent levels and not all the full-time costs of these people. So I don't believe that you need to hire a full-time person to fulfill these roles, but you certainly should try and reach out and find consultants who can bring these valuable services to you at only a fraction of the cost. Do it right the first time. Why I say that is make sure that you're doing your business and handling your internal controls and your other aspects of your business right up front, because we always have time to do things after the fact, but we never seem to have time to do it right the first time. So when I say right the first time, make sure that you have adequate internal controls. Make sure you've selected the right software and established the right chart of accounts that help to evaluate your business. And standard operating procedures, that you create standard operating procedures internally. Most companies and startup businesses don't take the time to create those standard operating procedures, but they always have problems with communication with other employees, and there's a lot of inefficiencies that occur when those standard operating procedures don't exist. Develop the right operating metrics and identify key drivers. Sure you have the analytical tools to focus on key success factors affecting your business. Sales should be tracked by product, channels, region. Staffing should consider hours in relation to output. I've listed a few operating metrics here to give you an idea about the kinds of metrics that you should be looking at. Sales per hour, cost per hour, units per hour are all measures of productivity. Utilization, when you look at assets or people or facilities, always be mindful of the utilization level of those assets, but also the capacity level for each of those assets. And measuring utilization relative to that capacity is very important for determining whether or not you're using those assets efficiently. I strive to get utilization at about 85%. I try not to be higher than that, because if you are higher, you're at risk of breakdowns and things like that. So 85% utilization is probably your best bet. Realization is another metric often used in the services industry. It represents the dollars that you actually can collect relative to the billable time that you have for an employee. And then idle time is another metric, very important. It measures the time that people are available versus the time that they actually are billable. And then there are other measures in labor that relate to productivity, and that's billable time over available time. And these operating metrics can go on, but they really should be unique to your type of business. And I'll talk a little bit more about this area. I've added in here contribution margin as another important metric that I wanted you to be aware of. And there's two different types of margin. The main one here is contribution margin, because contribution margin measures the difference between your direct revenue and your direct costs. It's like your incremental benefit that you get from the sale of a unit or the sale of a labor hour. And it's very important to understand how much are you getting per unit or per labor hour versus your cost. Gross profit margin is what is typically reported in financial statements. It is revenue less standard cost, and standard cost represents all of the overhead, variable overhead, fixed overhead costs associated with production. And when you consider revenue less overhead and all these other standard costs, you're able to calculate a gross profit margin, which is what typically gets included in the financial statements. And then the lastly, I have in here margin trend analysis. And trend analysis is to look at results over periods of time. Typically, we report trends on a monthly basis, but I want to encourage you to consider a 4-week period scenario versus the monthly reporting. When you consider that a business typically runs on a week-by-week scheduling, whether January ends with 31 days in it and February ends with 28 days with it, all that kind of has a way of distorting your results. If you're a restaurateur, going to weekly periods allow you to track results on a comparative basis, and even systems like QuickBooks allow for you to translate your reporting periods by weeks versus months if you wanted to do it in that manner. And I find it to be very useful to go and monitor trends on that basis. Full-time equivalents. If you're not familiar with full-time equivalents, it's very helpful when you have a group of part-time employees to be measuring your results based upon full-time equivalents, because full-time equivalents can be your baseline metric for evaluating results. And to calculate full-time equivalents, you're essentially looking at a 2,080-hour year or 173 hours per month type of scenario. Establishing key partnerships is another key area for improving your startup success. Establishing key partners can expand your customer base and accelerate your growth. Often sales, servicing, purchasing, and other businesses alliances drive success for a business. If you know how to approach and structure win-win arrangements between different strategically aligned businesses, but consider things like lenders aligning with retailers, suppliers aligning with contractors, retailers aligning with bus companies, tour operators aligning with travel agents, and think about all the different types of partnerships that might be common in your industry, and try and understand how to align with those types of strategic partners. The sixth point is to start raising capital early. It's been one of the most important factors for success of a business is to have sufficient amount of capital. And raising capital takes a long time. Soliciting additional capital from banks, grants, private investors, angel investors, venture capitalists, and investment bankers all take time. Most owners don't do this very often, so addressing the needs of these financing sources early and efficiency is a key to the new venture's success. This can be a very long and expensive process, which requires lots of soft skills. Seed capital can come from grant funding. Federal programs provide novel concepts for research, product development, and full commercialization. Funding through grants can be rewarding, so putting together a winning proposal is key. The researching, understanding the grant objectives and requirements, preparing the proposal, supporting with detailed financial models, working with the team to understand and document their roles, and much more goes into winning a grant. A highly competitive and often long cycle before receiving any grant funding. So I just wanted to summarize the startup phase here and open it up for questions if you might have any.
I don't think we have any at this stage, David. That's fine, but we can just carry on in the interest of time.
Okay, keep going. All right. The next stage is the expansion phase of a business. The way I look at this is once you've been operating as a successful business and you've earned comfortable levels of cash flows, you might be considering opportunities to change your business. Most entrepreneurs have one or two other ideas in mind that they want to pursue, and once they've gotten one project completed, they're usually off looking for the next. So I included this expansion stage of a business of things to consider. The first thing is to look at your systems and your internal systems to try and raise performance. Do a systems redesign, go through and bring a fresh new perspective to your business. Enhanced functionality can streamline operations. Dashboards can bring focus to key drivers of a business. Oops. I've done 9 software implementations, and the results have always benefited an organization in so many different ways. So I encourage you to look at what is taking place in your systems and try and see how things can be changed internally first and made way more efficient. Second, prepare a competitor or peer group analysis. Investment bankers prepare industry analyst reports that summarize the top tier in understanding an industry. These are top tier competitors of yours. If you can get a hold of analyst reports and read up on what's taking place in the industry, these reports can be a tremendous wealth of knowledge. They help with the understanding the industry jargon, the market capitalization, and comparable valuations of a business. Studying a public company's public disclosures in the management discussion and analysis section of the 10K, which is an annual report filed by public companies, helps to understand the most significant issues facing your industry. Forming strategic partnerships. Similar to what I was discussing earlier, growth can occur from partnering with other organizations. Sales agreements instead of building a direct sales network. Distributor agreements instead of a self-distribution network all add to forming strong strategic partnerships. Learn the basic principles of business valuation. There are 3 major areas of business valuation. The first is the value of your assets, your net assets, which include your intellectual property. The second is comparable sales of a like-type business. So when they refer to earnings multiples, for example, 3 times earnings or 1 time sales, those earnings multiples are what they refer to as comparables, allowing you to evaluate your own business. So if you own a pool business, for example, and you sell your routes for $1,000 per account, for example, that would be an earnings multiple. The third method is the discounted cash flow method, and it is considered to be the superior type of evaluation. In the discounted cash flow method, you need to evaluate your present value of your future cash flows. So you need to evaluate each period and discount it back to the present period to come up with a discounted cash flow value. It gets a little hairy, but that's considered to be your best bet. Another growth strategy might be to grow simply through acquisitions. And when I look at acquisitions, the first thing I look at is the strategic fit of a business. So if you're looking to sell, who are you going to sell to, and why would they want you to be acquired under their portfolio? What is the strategic fit? Then a financial due diligence and evaluating the financial implications of selling a business or buying a business once the full consolidation is completed. I would be looking at valuations of their business as well as the buyer and the seller, and then look for consolidation opportunities of different functions. And technology due diligence is evaluating the internal technologies of the two different companies, of the combined businesses. And then, of course, the legal due diligence, just making sure that all of the legal documentation behind the governance of a company are under control. As you can see, there are so many things that can go wrong in this space, and my biggest recommendation here is to get a strong team of advisors to help in this area. Another expansion matter that can come up, often does, is the consideration of whether or not to buy versus lease versus build analysis. And when you use that type of analysis, it's very important to use what we call the time value of money, or consider that a dollar today is worth a lot more than a dollar in the future. There's a lot of formulas and such that go into determining the net discounted value. But projecting after-tax cash flows is probably the most challenging and most difficult part of using this type of analysis, because you're being asked to project sometimes 5, 10, 15 years in advance, and how would you be able to project those cash flows? But that is the process. And then discounting those cash flows at the expected rate of return for your investment is another important factor that comes into play for using this type of analysis. The seventh area is to align your team's incentive plans to achieve multiple goals. An incentive plan empowers influencers to do good things. In my opinion, 15% of key employees' base should be incentives. And if you have a higher degree of influence, if your key members have a higher degree of influence on the outcome, then they should be receiving a higher percent of their compensation in incentive pay. Lastly, individuals, teams, and companies' performance can be taken into account for paying out incentive pays. It doesn't have to just be the individuals. Operating metrics we talked a little bit about, but I believe that operating metrics can help the business manage itself. So a lot of times, if you're in this expansion phase and you're doing really well, creating the operating metrics to help you monitor your business allows you to see trends in the operations. We talked a little bit about different operating metrics. These are a little different. You can look at things such as sales per person, cost per person, hours per unit, sales per call handled, billable hours per person, units per hour. These are all examples of different types of performance metrics that you can use that will help you to manage the business and different sections of your business. And share your results. Don't just keep them in your drawer and look at them and share them to your board. Share your results with other people in the company and make sure that they're aware of the things that you are tracking. And if you're in the expansion mode, you're probably going to need more capital. So it's always better to look for money when you don't need it. Make sure that if you are intending to expand, that you manage those banker relationships and try and get as much available funding as you can before you actually need it. So I've completed the expansion phase summary and summarized the key points here: upgrades, peers, partnerships, valuations, acquisitions, incentive plans, and metrics. So I'm going to open it up for any questions that you might have in this section.
Thanks, David. And we do have a couple questions here. Hopefully we can get through them without taking up too much time for your next section. Weil, I hope I pronounced that correctly, sorry if I didn't, but he's asked a question: as an engineering consulting business, to apply all of these tools might be kind of costly, so would you recommend a template for a small business? And this might be a question answered in further detail later on, but just briefly, what would you say to that?
I'm not sure how small. You're talking about an engineering firm, which is a professional services firm. I've used software from Deltek, which has been pretty good software. There's different types of software that are available for professional services area, and oftentimes those softwares or those other types of metrics, such as utilization, idle time, can come from payroll systems as well, or integrate from payroll systems. Obviously, the easiest is also in Excel, but I don't know of any specific one that addresses things like revenue realization or utilization of staff. But I'm glad he's asking those types of questions. There is a lot of material available on that side, but in general, I would look at professional services, operating metrics, something like that.
Great, thanks. And Stephen has asked, he had this question came in when you were referring to your second point in the expansion phase, assuming that these reports are only available for publicly traded companies.
Yes, the nice part is the 10K, the 10Q, these are all available for public companies. There are some private company databases, but it's difficult to get them, and they're subscription-based, and sometimes the data is a little bit suspect. They don't have all very good data. So I usually point to the public companies first and gather what you can through them. When you get into the 10Ks and the industry analyst reports, in the industry analyst reports are really valuable information. Sometimes you have to go to the specific investment underwriters or investment bankers publications. IBIS is one area that, or one publication that seems to provide a lot of very good information for pretty accessible through university research areas and at very low costs. But yes, the public companies, though, provide a lot of good information, and when you go into those industry analyst reports, you can go into the footnotes as well as the other companies that are referenced are in those reports. There's usually 10 to 20 companies that are referenced in these industry analyst reports.
Thanks, David. And I know we're right at about 1:30 here, but just really quickly, Tom has asked, how often would you suggest getting a value done on your business?
I would suggest how often is probably not as important as when. If you're looking to sell your business or if you're looking to acquire a business, I just would want people to understand how businesses are valued and how you would be valuing your own business or any other business as you look into acquiring. It's an art, and it gets pretty deep into the due diligence aspect. So I would say if you're not familiar with the process, take the time now to do that. If you're looking at selling a business, expect that you're going to be spending about a year, at a minimum about a year, to prepare for that sale. And if you understood what the components of the valuations are, it will help you to focus your efforts prior to that sale on the things that will be the most important for you in increasing your valuation and succeeding in the sale.
Thanks, David. That was it for now. I think we can move on to your next part.
Okay. Thank you for the questions. Great questions, by the way. The third stage is the downsizing, or what I prefer calling is the right-sizing phase. And that's usually in economic downturns. You know, it's not always good that we're not always facing bull markets. Oftentimes, new competitors come into the marketplace, an industry is contracting, or technology brings obsolescence. So very often businesses need to downsize or restructure. And I've had to cut many firms in half myself, so it's a very difficult and emotional thing to do. So I want to mention a few key points in here that if you're considering or faced with that situation, you definitely need to manage your cash flows. Ideally, you would manage them on a weekly basis. 6 to 8 weeks ahead is what I would recommend. Know your runway. And what a runway is let's say I have $100,000 in my bank and I have a burn rate of $20,000. I'm going to only last, in that case, 5 months. If I don't make a change or do something differently. So you manage your runway by evaluating what costs you're going to take out and how much longer is that $100,000 going to last me, and it's a measure of time. I have 5 months, 4 months, 3 months, for example, and as I manage through that runway, I know what I can spend and what I can't spend today. If I need to extend that runway out another 6 months or so, I have to be very aggressive about reducing my payments out. So, yeah, manage your cash flows weekly and know your runway. Eliminate redundancies and streamline your operations. We're trying to do that all the time, but oftentimes we get caught up in the details there. But what I like to do is to step back and evaluate the inputs and the outputs and look for the easiest way to get there without a lot of the processing in the middle. Restructure debts and develop manageable workout plans. Maintain banking and vendor relationships. I think this is a very important point, maintaining these relationships, and having to deal with this so many times, it's so important to answer phone calls, to have the conversation, to share what's happening in the business as much as you possibly can, and to respond to people honestly and directly, and without lying or anything, saying anything that you don't believe will be able to materialize, you can still be able to have the conversation to emphasize your strategy and the ways that you're going to come out of this problem or downturn. And then the other thing is to share with them how they will get paid. I've even shorted, or not shorted, but given vendors 10% of what they're asking. And as long as they can get something, you are able to maintain those relationships. So negotiate settlements with vendors if possible. You know, never lie or promise things that you can't deliver. Share your plan. We talked a lot about those things. Downsize staff and facilities. Consolidate or outsource functions. Don't drag this out. Oftentimes people know what needs to happen. They can see it. It's so visible that they have excess facilities, or they have too many people and they need to consolidate functions. And unfortunately, they drag it out because they don't want to face the fact, or they don't know how to implement a plan. But the hanging on of this ends up becoming extremely costly, and it doesn't need to be. So please don't drag things out. And when you do make the cut, make sure that you have a clear plan for the people that are remaining with your organization. It's so important for them to understand what's going on, or that some of your best people will leave. Manage corporate and personal risk. Don't forget, go through your files, make sure you know which ones you have personal guarantees out on, and also understand that I believe it's federal law and usually state law that officers with check signing authority are personally liable for payroll and payroll-related tax liabilities. So make sure that those are people that get paid first. Solicit strategic investors. Create and show them your workout plan. Update your business plan. Create a due diligence package. What that means is get all of your legal documentation together. Make sure you have all that stuff ready to go so you can execute either a infusion of capital or somebody who wants to buy you. Safeguard your assets from theft or creditor claims. Sell idle assets early and orderly. Don't wait for the fire sale. Secure other assets before they end up walking out the door. And understand which assets are subject to claim. Normally those assets, such as large computer equipment or things that are on lease, like a leased piece of vehicle or something like that, are subject to claim. And manage those claims and that conversation with those creditors very carefully, because some of those assets that you're utilizing, without those, you may be out of business a lot sooner than you thought. Lastly, avoid bankruptcy. You know, vendors can be very patient. Most vendors, although they may kick and scream, will be very happy to take something versus nothing. Having them take a haircut or just get a little bit of money up front every month oftentimes allows them and you to stay in business. Lawyers are just too expensive. So bankruptcy lawyers, you know, they're one of the most expensive lawyers in town. So it's generally an area that you don't want to go down. Chapter 11 is a reorganization bankruptcy provision, and it allows you to hold off on all your debts and the payments of all your debts. And so it allows you to continue to operate, and then it protects you against claimants who are trying to foreclose on you or or file for you know, a lawsuit against you to get their assets. By filing Chapter 11, it gives you some time to prepare a workout plan and potentially for recovery. And then it also forces them to try and work through a reorganization of that of those debts, and sometimes recovery. Chapter 7 is a liquidation bankruptcy scenario, in which case the courts liquidate your business to the highest seller or highest buyer, and various assets are up for sale. And I put in parentheses here that there is value in the intellectual property. Oftentimes companies think they're selling assets, just hard assets, but there's an intellectual property component typically with every business, whether that's patents, trademarks, things like that, brands that have value that are not part of your asset base that gets sold. By protecting that intellectual property, you can end up with value even out of bankruptcy. So the downsizing or right-sizing phase summary, we talked about a weekly cash, streamlining operations, workout plans, settlements, downsizing staff. I'm open for any questions that pertain to this area as well as the earlier sections.
Thanks, David. We did have a question come in from Dave. What tools would you recommend they use for tracking cash flow?
Excel is, to me, the best, most flexible tool. Always looking at cash inflows and outflows in very specific transactions. So looking at your AR aging, your AP aging, and pulling off those items that you know are going to come in, and the things that you know you're going to pay, and the things that you're going to partially pay. So I have a $100,000 invoice, and I'm going to cut them a check for $10,000. There's really no systems out there that's going to tell me that. The only thing that is going to do it is, I would say, a custom-built Excel spreadsheet.
Great, thanks. We're actually, I think that was just one of the last questions we had, and we're almost right on time here. But thank you, David. You covered quite a lot of great information there. So, folks, I know some people have been asking, you will get this presentation emailed to you later today along with the recording, so if you want to go back through anything. And I want to thank you all for attending today. If you want to just flip over to that next slide, if you have any questions for David later on, you can contact him. His information is right there. And also you can check out all of our previous BOSS webinars and view on demand by visiting our website at the link down there at the bottom of the screen. And you can also register for our next session, which will be on May 18th, focusing on increasing your business's value and preparing for selling, and that's either a planned or an unplanned exit. So be sure to check that one out. And thank you all again for attending, and thanks, David, for a great presentation.
Okay, Stacy, thank you.